Hello guys, welcome to another lesson, and we're going to be talking about implementing macro analysis in setup progression for higher time frame analysis. Okay, so let me get rid, or actually, let me use a different chart for this, and we're going to come back to this chart. Now let me ask a question here: how many times have you had the level in price? Okay, at the level in price, let's say the market created a bullish order block. So let's just do a very rudimentary diagram of a bullish order block. And you were anticipating the market to trade on there. Obviously, that's a buy, all right? Off the bullish order block, it's a clean buy right there. And you're anticipating the market to trade on there and offer some kind of displacement higher at discount. How many times have you seen the market trade up, trade down, and then trade through your order block only for the market to continue to trade higher? I'm sure it is a lot of times. Okay, if you've been trading for any period of time, you would have seen. If you've been trading with these concepts for a period of time, you would have seen this play out. Okay, and this is where implementing macro analysis using higher time frame progression comes into play, because a lot of times what you are actually ignoring is that below or beneath this daily bullish order block, there was some high time frame level discount there that the market was referencing, which was a weekly bullish order block or a monthly bullish order block or a monthly breaker block. But you actually missed that. So you're thinking now, oh, price has to trade down there into the order block, and there is no anticipation that price could potentially trade through the order block, trade down to the higher time frame discount, and see a rally or a bounce. I'll use a very perfect example. That was last week, because it's Sunday for me right now, so it is a new week. But that was last week. My entire timeline, and for those of you guys probably are watching this in the future, I wish you seen the way my Twitter timeline was last week, because essentially I follow a lot of traders on Twitter, and everyone except myself, I mean literally everyone, no one was bullish on dollar except me. No one I knew of. Okay, I'm not trying to boast or nothing. I'm just explaining the sentiment here. But none of the people I follow or all the accounts that were suggested to me were bullish on dollar. Everyone was all bearish on dollar, because they were looking at this as equal lows, right? Equal lows in price should get tagged. That's the thought process. So I have a low here, and they all think, well, this is equal lows down here, right? And this is no longer a valid bullish order block because the market has traded through this order block, so it's not valid for bullishness. Now, what they were actually missing was context, and I think this is something probably I'm going to have to discuss in the lesson today. Now, if you zoomed out to a monthly time frame, you can see we have a monthly mitigation block. Now, what have I talked about with wicks like this in candlesticks? That they are thin volumes of liquidity. Okay? So if there are thin volumes of liquidity, what are they essentially? They are market gaps. So they can act as fair value gaps. Now, if you take your Fibonacci measurement from the high to the close of the candle, where essentially the week starts and ends, so let's do it this way. From the high of the candle to the close of the candle, and we did it like this. This is going to be the consequent encroachment of the wick of this candle, because we're trading this wick as a gap. Okay, so that's the consequent encroachment of the wick of this candle, which is the purple line. Now let's reset the chart. If you go down on the daily time frame, where did you see displacement from? From there. Look at the borders of the candle there. Look at the wick of this candle. There. All of this was all institutional accumulation at a higher time frame discount. But if you were only zoned in on the bullish order block, it looks like it has failed, right? Because we see in theory the market should not trade through the mean threshold of the bullish order block. That's ideally what we don't want to see in price. And this is one of those times where you can know when this is still valid, because a lot of traders will look at this and say, okay, well, price is not supposed to trade through the main threshold of a bullish order block, so this kind of trade below and this kind of trade below, so dollar obviously now is bearish because it's traded through the bullish order block, and now the bullish order block has been invalidated. But what is not being taken into consideration is the fact that we are not in actuality only referencing the bullish order block as a pure discount array. Okay, if you went higher than the bullish order block, you would have seen first up that monthly discount, which is the consequent equation of that monthly, the week of that mitigation block. That's number one. Number two, if you went out to the monthly again, this is a monthly fair value gap. So we're gonna actually use red here. The low of this candle is 101.297. So we're gonna do 101.297. And the eye of this candle is 99.418. So we're going to do 99.418 here. Let's see if it actually is set. Okay. And if you went back down to the daily time frame, you're going to see all of this run lower was simply a run into that weekly fair value gap. Okay. That was where the market was referencing. So now it looks like it traded through the bullish order block, and it looks like, well, our daily discount is invalidated. But no. Okay, this is where you use the time progression, meaning you go a time frame higher to get a better view of price, to see where price is actually referencing. Now, the best way to get a holistic view of price action is not to only use one time frame. You have to take into factor multiple time frames. So when I'm doing my daily analysis, I already have a perception of what the weekly looks like. I already have a perception of what the monthly looks like, the monthly perspective looks like. So when I'm going into the daily time frame, I know what daily PD areas are in context to the monthly or weekly, so that if it looks like a daily discount is failing or a daily premium is failing, I can take into consideration if it actually is failing, or if the market is just referencing a higher time frame discount in which that daily discount is inside of. Hopefully this makes sense. So this is how you implement macro progression in hard or macro analysis in terms of setup progression for your hard time frame trading. Okay, you always have to look at a time frame or one or two time frames higher than your time frame of analysis to get a better view of price before you switch over to your lower time frame. And that way you don't get caught off guard by this, anticipating that the market has to take out equal lows. The market does not have to take out equal lows if it is rallying from a level of discount. Okay, and this is my problem with retail thinking when utilizing this concept. And I think this is going to be a little bit of a rant going into the end of the video, and then we're going to close out the video and go into the next one. Okay, but it's a little bit of a rant. But a lot of institutional traders, quote-unquote institutional traders, they absolutely love their patterns when it comes to institutional trading. They go into the marketplace looking for equal lows to get traded into, equal highs to get traded into, up into. The question is why, and that's the question you always have to ask yourself. Why does should price do something? Without knowing why price should behave, you have no context. There is absolutely no context to your trades. If you don't know why price should behave, there should be no execution. It's low probability. Because the first thing you need to do in your analysis is you need to know why price should move. Why is price going to move? Why should price move? That's the first question. Now, once you can identify why price should move, then the next question is how should price deliver? But now, a lot of, again, quote unquote institutional traders, they go into price looking for target levels, and you're looking for draws on liquidity. And you can't see me right now, but I'm using the air quotes right now, saying draws on liquidity. You're identifying draws on liquidity because they saw an equal low or they saw an equal high, so they think every equal lows or equal high I should get traded up into, because that's what we teach. Right, we teach that retail looks at equal lows and equal highs as support and resistance, so the market has to trade up there. That's absolutely wrong. If you cannot validate why the market has to trade up into equal lows or equal highs, you are no different from retail. What separates yourself as an analyst from retail as an analyst? I'm not talking about trading right now. I'm talking about analysis. What separates you as an analyst from retail as an analyst is your ability to role play as a central bank, as a provider of liquidity. I'm going to repeat myself one more time. Okay? What separates you as an analyst from retail as an analyst is your ability to role play as a central bank. Actually, just give me a couple seconds. I'm actually tweet this out because this is really important. And I like to do stuff like this. When I have a moment of like, oh, this is a good soundbite, I'll just like tweet it out. So I think this is the part I just skip forward like 10 seconds or 20 seconds, and you hear me continue my rant into the video. That was a good tweet right there. And this is something, when I started out, and I think this is something that really contributed to my growth in terms of analysis and trading. And if you're listening to me right now in the course, you can go back and watch all my evening commentaries. I have been documenting my forecast every evenings for almost 2 years now. And if you kept a score of them, you would see they're over 90% accurate in terms of the prognostication of the daily candles and our daily targets. And what has really helped me is my ability to role play, and that's the perspective I try to teach in each of the videos. If you are going to go this route of learning institutional trading, I think this is going to be one of the more important videos, even though the concept I'm teaching today is not maybe that important, but it's going to be one of the more important videos of the course. If you are going to go this route of analysis or being an analyst as an institutional trader, quote unquote institutional trader, even though you're not actually an institutional trader because you don't have the funds, but if you're going to go this route of being an analyst and trying to trade like the banks, even though that's a cringe thing to say, then you have to learn how to role play like the way the banks would. Okay? Why should the market do something is what you're determining 80% of the time. 80% of the time, your question is why. Once you can determine why the market should do something, all you need to literally do next is to determine how. And that's the easy part. Like you saw, that was last week. I already gave you the buys on Monday, and I told you what to look for. And the upside objective was up here. And all we're doing all throughout the week was we're looking for reasons to buy intraday. That's all we're doing. And we just kept doing the same thing. And you saw the outcome, the performance, and everyone on Twitter is going insane and they're thinking, oh, this man is absolutely insane. This man is a superstar. No. We already did the hard part, which is knowing why the market should trade. And once we knew why the market should displace, we already identified where it should displace up into. So this is the main thing you're contending with as an analyst. Okay? As an analyst, the main thing you're contending with is why the market should displace and where the market should displace into. I think it's also another fire soundbite too. I'm sorry, there's so many soundbites here, and I'm scared of actually losing them. So your main contention as an analyst is number one, you gotta know why the market should displace. Number two, you gotta know where the market should displace to. And that's aka counterpart of liquidity. And this is the bulk of your analysis. Everything else in between these two things, the knowing of the why and the knowing of the where, is what we call narrative. Okay, the narrative of how each should happen. So that your first thing you're trying to figure out is why something should happen. If you don't know why something should happen, you're going to fall subject to manipulation in price. You're going to FOMO in because you don't know why something is happening. You don't understand why something is happening. So your first contention as an analyst is to know why something is happening. Why is this happening, price? And then know where it's going to. Once you can understand the why and the where in delivery, then all that's left is the how, which is the easiest part of analysis. How should it deliver? I taught you on the previous video. If you're looking for buys, simply look for a discount on the lower time frame. Lower time frame discount at a specific time period, easy. We're going to talk about time periods on the lower time frame module. Look for discount at a specific time period, you're good to go. If your bias is sell, you know why the market should displace lower, you know where the market should displace lower into, then you're looking for a specific time period and you're looking for lower time frame premium to short into. Easy. This is the roadmap to profitability, guys. It seems so simplistic, but it is the roadmap. It actually is. It's so easy. Okay. I think this is not a really mind-blowing route like that because I was sweating in between, but they're more like epiphanies. Even though I know all these things, but just hearing me say them is refreshing, honestly. And I hope you gained a lot of value from this. So I'll catch you on the next video, and you guys all have an awesome trading. And I'll see you on the next one.